Hey, real quick, thank you for tuning into this well-balanced podcast brought to you by Vector Wealth Management. We're a full-service, fee-based wealth management firm working with clients across the U.S. We do financial planning and investment management for individuals and families. If you're new to Vector and would like a portfolio and plan review, go to our website, vectorwealth.com, and click on the free assessment to get started. And now back to our show.
Are you someone who is a resident, or said another way, domiciled in another state, but you own property here in Minnesota? Typically, I see this when someone is originally from Minnesota, but then they've retired to a southern warm state, but yet keep a residence here in Minnesota where they spend their summer months. If this sounds like you, listen up, because this podcast is for you. And if you haven't figured it out by now, I'm going to be talking about Minnesota estate tax. I'm Sharon Calhoun, Managing Director at Vector Wealth Management. I was recently in a client meeting, and an important topic came up, and I thought I would share it with you. Minnesota stands out as an especially tax-heavy state when it comes to both estate and income. Minnesota is one of only a dozen U.S. states that still impose a state estate tax on top of the federal estate tax. And if you are a Minnesota resident and pass away with an estate with over $3 million, your estate will owe Minnesota estate tax on the amount above that threshold. The tax rates usually range from about 13 up to about 16%. By comparison, the federal estate tax exemption is roughly $13.9 million as of 2025, and then imposes about a 40% on the excess. Minnesota's exemption is much lower, meaning that many moderately wealthy families get hit by state death taxes that they wouldn't face federally. This is why Minnesota is often cited as having one of the least favorable estate tax laws for high net worth individuals. And of course, beyond estate tax, Minnesota residents also face high income taxes during life. So Minnesota's state income tax has 4 brackets, topping out at about 9.85, one of the highest rates in the nation. By contrast, for example, Florida imposes no state income tax at all. So for a wealthy individual, Minnesota's nearly 10% income tax can cost 6 or 7 figures annually, which is a major incentive sometimes to relocate. Minnesota also levies hefty property taxes in certain counties and also has state sales tax, sometimes about 7%. So the overall tax burden in Minnesota consistently ranks among the highest. Okay, now that I've given you some background on Minnesota tax, let's talk about my scenario. If you are a permanent Florida resident or a permanent resident of any other state who owns property in Minnesota, your estate could be subject to Minnesota estate tax, even though, let's say, for example, Florida doesn't have a state tax. The tax is going to be calculated on the value of your Minnesota-based assets if your total federal gross estate exceeds Minnesota's $3 million exclusion amount. Let me point out, in legal and financial context, when I say domicile, that refers to your permanent legal home, while a residence is simply a place where you happen to be living at a particular time. So when I refer to a resident of Florida, I am referring to Florida as their permanent domicile. Let's talk about some key Minnesota estate tax rules. First of all, a non-residence estate is required to file a Minnesota estate tax return and may actually owe tax if you flat out own real estate or tangible personal property in Minnesota. Second, if you have a federal gross estate, which is going to be assets everywhere, not in just Minnesota, that is larger than the Minnesota's $3 million exclusion amount. Okay, so how is this tax calculated? Let me explain this first, and then I will walk you through an example. So the prorated calculation, the tax is not calculated solely on the value of the Minnesota property. Rather, the total estate tax liability is determined by a prorated formula. There's going to be two steps that we're going to use to make this calculation. Step number one, the estate tax is calculated as if the decedent were indeed a Minnesota domiciled resident with their entire estate. Step number two, a fraction is determined. The numerator is going to be the value of the Minnesota property, and the denominator is going to be the total federal gross estate. Finally, the tax from step one is multiplied by the fraction from step two to find the total Minnesota estate tax due. So let me now give you an example calculation. Suppose a Florida resident dies with the following assets: a Florida home and other assets valued at $4 million, and a Minnesota cabin valued at $1 million. So you would have a total federal gross estate of $5 million, right? You've got your 4 in Florida plus your 1 in Minnesota. Here's how the Minnesota estate tax would be calculated. You're going to calculate the tax as a resident. So you're going to take a $5 million estate. That is going to be $2 million over the $3 million Minnesota exemption amount. The tax on that amount using Minnesota's progressive tax rates would be calculated. And so in my example, that's going to be $299,000. Next, you're going to determine that Minnesota property fraction. The value of the Minnesota cabin, which in my example is $1 million, that's going to be divided by the total federal gross estate, which was $5 million, resulting in a fraction of 1/5 or 20%. Okay, so how much tax is now owed to Minnesota? The tax calculated is going to be, again, as if you were a resident. You take that $299,000, it's multiplied by that Minnesota property fraction, which in my example is 20%. That's going to result in Minnesota estate tax liability of $59,800. Wow. That may be a surprise to many of you, but here's a few other important considerations. There is no portability in Minnesota. So Minnesota does not allow married couples to combine their estate tax exemptions, unlike the federal estate tax. This makes proper planning critical for couples who own assets above that $3 million threshold. Another consideration are gifts made before death. Any gifts exceeding the annual federal gift tax exclusion, which is $19,000 for 2025, that are made within 3 years of death must also be included in the Minnesota taxable estate. And last, entity ownership. If the Minnesota property, for example, is owned through a pass-through entity like an LLC or an S-Corp, the Minnesota Department of Revenue will disregard the entity and treat the decedent as if they personally owned the property. I know that was a lot of information. So if you think this pertains to you or someone that you know that could perhaps benefit from our services, because this also pertains to them as well, please reach out to Vector. We know this is a very complicated topic, but I did want to make our listeners aware of this today because I think a lot of times this ends up being a surprise, not for you, but usually for your heirs. Until next time, stay safe and be well. Bye for now.
Hey, thanks for listening to our podcast. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or